Welcome to today's afternoon review. We will be talking about the US dollar, crude oil, and gold. First, US dollar. While tariffs affect the sentiment, actions that disrupt capital flows pose a greater risk to the US economy. With an open capital account, the US is vulnerable to sudden capital outflows if confidence drops. The country relies heavily on foreign capital, drawn in part by the dollar's global reserve status. However, this cycle could be disrupted. A key concern is the Trump administration's proposed Mar-a-Lago agreement, which includes a weakening the US dollar, even though it shows no signs of being significantly overvalued, and replacing existing US debt with 100-year or even perpetual zero-coupon bonds at below market rates. While the goal is to reduce borrowing cost, such actions could actually undermine investors' confidence and potentially challenge the dollar's reserve currency role. So next, we'll be talking about the WTI crude oil. Unlike 2020, this market's downturn isn't about a pandemic, but it is about a trade war. Oil demand is expected to dip only slightly, around 1%, but the price reaction has been very strong. US shale producers generally need oil above $65 to stay profitable, and the recent drop threatens the output cuts. Saudi Arabia's modest production increase aimed to discipline OPEC members, but had limited market impact. Historically, Saudi has initiated 4 oil price wars over the past 3 decades, and a 5th war remains very possible. In addition, geopolitical tensions from the Russia-Ukraine conflict and instability in the Middle East keep the market volatile. If WTI drops towards $50, it could become a strategic buying zone. For now, caution is warranted. And last but not least, I will talk about gold. In today's unpredictable landscape, gold has solidified its role as a safe haven asset. With a 10% tariff still in place and recession concerns rising, the demand for gold remains very strong. And over the past year, it has gained 22%, with a total return of 37%. Although prices are high, they are justified by the current risk. And investors should also consider rebalancing if their gold allocation has exceeded the targets, but extreme moves are not necessary. Given market volatility, maintaining a diversified portfolio with a measured gold allocation is likely the best path forward. And this is all about the afternoon review. Thank you for watching.